Hey everyone, welcome back to Corporate Decoder, the place where we uncover the hidden stories within corporate filings. And tonight, we're diving deep into Digital Brand Media and Marketing Group's latest annual report, a document that looks like it has been through a digital marketing storm and survived to tell the tale. Before we jump in, if you love getting straightforward insights from these complex documents, smash that subscribe button and ring the bell. We also have a fantastic Discord community waiting for you, linked right in the description, a place to connect and keep the conversation going. Alright, let's get straight to it. This is their big annual report for the fiscal year ending the 31st of August 2025. It is essentially a yearly checkup report filed with the US Securities and Exchange Commission, or the SEC. This is for Digital Brand Media and Marketing Group Incorporated, ticker DBMM. Now, this report is for a company that's been through quite a bit of transformation. They talk a lot about pivoting their business, moving from traditional digital marketing services to something more focused on AI and consulting. They even have a section on cybersecurity, which is pretty standard these days, highlighting how they try to protect their digital information from threats. It's good they're thinking about this, especially with all the data they handle. Now let's talk about where the rubber meets the road for investors, the stock market itself. Traded on the OTC markets, their common stock symbol is DBMM. The prices here are pretty wild, reflecting the volatile nature of smaller publicly traded companies. For instance, in the first quarter of 2025, the high was just $0.0032 and the low was a mere $0.00006. That's less than a penny per S-hair. This indicates a very small market cap and a lot of speculation or very low investor confidence at that time. They had very few shareholders of record, around 122 for most of the year. This next part is like reading a company's diary. It's management's own account of how they think they're doing, what happened during the year, and what they plan to do next. They spent a lot of time talking about a big shift, a pivot from being a marketing agency to becoming an AI, augmented go-to-market consultancy. This is a huge strategic move, trying to climb up the value chain. They really emphasize that they are moving away from commoditized services like pay-per-click advertising towards something more strategic, using artificial intelligence. Or AI. They believe businesses are wasting trillions on old marketing methods, and they want to be the ones to fix that by offering AI-powered strategies. They've even developed their own AI platform called the Digital Clarity Intelligence Engine, or DCIE. This sounds like their big bet for the future. This DCIE is a big deal for them. It's not just software. They say it is the codification of 2 decades of consulting expertise. It's designed to give clients deep insights, streamline strategy, ensure data accuracy, predict market shifts, and even help with digital transformation. It uses both public AI models like those from OpenAI and Google, and their own private ones to keep sensitive data secure. The idea is to make businesses more efficient and intelligent in how they reach customers. They see this as a way to eventually license their technology, which could bring in more predictable, recurring revenue beyond just their consulting services. Looking ahead to fiscal year 2026, they are projecting revenues of at least $1,200,000. This is a significant jump from 2025, driven by the commercial launch of their DCIE platform. They expect this to create much higher priced offerings, convert pilot clients into paying customers, and introduce a subscription model for recurring revenue. They are also expanding their presence in the US, particularly in California's tech hubs, which is a smart move given the concentration of potential clients there. Now for the nitty-gritty, the numbers themselves. Let's look at their income statement. For the year ended the 31st of August 2025, their revenues were $137,998. That is a significant drop from $237,868 in 2024, a decrease of about 42%. This drop in revenue is a direct result of them intentionally moving away from those older, less profitable services to focus on their new AI consulting model and building out DCII while revenue is down. Their cost of revenues also dropped considerably by 52%. This shift led to a gross profit of over $25,000 in 2025. A substantial improvement from just over $3,000 in 2024, even though the overall revenue was lower. This hints that their new strategy, though smaller in revenue scale, might be more profitable per dollar earned. However, their operating expenses, specifically sales, general, and administrative costs, went up by 22% to over $569,000 in 2025. This increase is likely due to the investments they're making in business development and in building out their new business model and technology. The bottom line net loss was about $1,060,000 for 2025. This is slightly worse than the $1,045,000 loss in 2024. This is a common pattern for companies undergoing major strategic shifts. They invest heavily in the future, which can increase losses in the short term. And on a per share basis, the net loss was $0 for both years, which simply averages out to a very small fraction of a penny. Now let's look at their balance sheet, which is like a snapshot of what they own and what they owe on a specific day. As of the 31st of August 2025, their total assets were just over $58,000. That is a small amount. Most of it is tied up in current assets like cash and accounts receivable. Their cash on hand was only about $23,000. That is very little cash for a public company, which is why they keep mentioning their need for capital. On the other side, their liabilities were significantly higher, around $8.4 million. This includes a large amount of accounts payable and accrued expenses, over $1.3 million. They also have substantial loans payable. The most striking part here is the total stockholders deficit, which is negative $8.3 million. This means that if you were to sell all their assets and pay off all their debts, there would be nothing left for the stockholders. In fact, there would be a shortfall. This deficit has grown from about $7.5 million in the previous year. This leads to a crucial section called going concern. The auditors flagged that the company has a history of losses and a capital deficiency which raises substantial doubt about its ability to continue operating. They have loans and convertible notes totaling $3.7 million and not enough cash to cover them. They are relying on a commitment letter for $250,000 and the potential for a larger capital raise to stay afloat. This is a very serious warning sign for any investor. It means the company might not be able to pay its bills in the near future. Here is the auditor's opinion. They state that the financial statements present fairly, in all material respects, the company's financial position. However, they also highlight the going concern issue, echoing management's own concerns. A critical audit matter they mention is revenue recognition, noting that significant judgment is involved in how they account for their various services. This means it is not always straightforward to determine when and how much revenue to book. Now let's look at the cash flow statement. This shows where their cash came from and where it went. In 2025, they used over $537,000 in cash from operations. This is tied directly to their net loss. They didn't have any cash from investing activities, which is not unusual for a company focused internally. However, they did generate over $509,000 from financing activities, mostly from taking on more loans. Their cash balance at the end of the period was a mere $23,000, down from $49,000 the year before. This continued decrease in cash is concerning, especially given the need for significant investment in their new AI platform. This note gives us more background. It confirms that Digital Clarity is their main operating subsidiary based in the UK, and they are heavily focused on AI and marketing consulting. Here again, they reiterate the going concern warning, highlighting the $3.7 million in outstanding debt and underscoring the non-binding commitment letter for additional funding. This note details their loans. They have over $3.7 million in loans payable. Most of these are unsecured and due on demand, meaning lenders can ask for their money back at any time. Some have interest rates up to 12%. Their maturity schedule shows a very large amount due in 2026, which is their immediate next fiscal year. This is a significant upcoming pressure. They also have convertible debentures, which are basically loans that can be converted into stock. These are from before 2015 and 2016, and the company has been working to resolve them, often by issuing shares. While they are dated, they still represent a financial obligation. This is an interesting one because it shows how they handled some of their debt. In 2025, they managed to settle a significant chunk of convertible debentures worth about $739,000 by issuing 100 million shares of common stock. This resulted in a large gain on derecognition, essentially recognizing a profit from settling debt for less than its full value or through a favorable share exchange. This strategy helps them reduce their debt load but also dilutes existing shareholders. On the tax front, they have a significant net operating loss carry forward of about $9 million. This means they have tax losses from previous years that can offset future profits, which is a good thing if they ever become profitable. However, they have a valuation allowance, which essentially means they do not expect to be able to use these tax benefits, likely because they are not confident in future profitability. This could be a significant risk. 5 customers accounted for 100% of their revenues in both 2024 and 2025. This means if just 1 or 2 of these major clients leave, their business could be devastated. This is a classic sign of a small company relying too heavily on a few key relationships. Let's quickly look at the leadership. Reggie James is the Chief Operating Officer, and Linda Perry is the Principal Executive and Financial Officer. Linda Perry has a very impressive background, having worked with major global companies like ExxonMobil and Credit Suisse. Reggie James has a history in digital media, working with pioneers like Yahoo and Ziff Davis. These are experienced individuals, but it's important to see if their experience translates into success for this company. Looking at executive compensation, Reggie James earned about $170,000 in 2025, with a portion of that remaining unpaid. Linda Perry earned $150,000 in both 2024 and 2025, with the entire amount remaining unpaid. This unpaid compensation, especially for the executive officers, is a red flag. It suggests the company might be cash-strapped and struggling to meet its payroll obligations, even to its top leaders. Reggie James and Linda Perry each own less than 1% of the company's common stock personally, but as a group, they hold around 15.9 million shares. Importantly, they also collectively hold 1.2 million preferred shares. This direct ownership by leadership shows some commitment, though the percentages are very small given the overall large number of shares outstanding. The audit fees for 2025 were around $40,500, and for 2024 about $38,225. These are relatively low for a public company, which can sometimes indicate a simpler audit or a smaller company. There were no significant fees for other services like tax or consulting from the auditors. So, what is the big picture here? Digital Brand Media and Marketing Group is in a massive transformation. They're betting big on AI and moving from a traditional marketing agency to a high-tech consultancy. The strategy sounds innovative, and the DCII platform could be a game changer if it delivers tell a story of struggle. They have very little cash, growling debt, and a significant going concern warning from their auditors. Their revenue has dropped significantly as they shed older business lines, and while their new AI focus might be more profitable per dollar, it's not yet generating substantial overall revenue. The unpaid compensation to executives is a concern, and the customer concentration risk is very high. For investors, this is a high-risk, high-reward situation. If their AI strategy and platform DCIE take off as planned, they could see incredible growth and profitability, but the immediate financial health is precarious. And they desperately need that planned capital infusion to survive and execute their ambitious plans. It will be critical to watch if their projected 2026 growth materializes, and if they can stabilize their cash situation. Investing here would be a bet on their future vision rather than their current performance. Alright, that is our breakdown of DBM's latest filing. What is your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments if this analysis was valuable. Hitting that like button really helps. And subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.